What if I told you that the 401k you've been diligently saving in for the past 30 or 40 years, the one your employer told you was the key to a secure retirement, might actually be a financial tax bomb that's been ticking away, waiting to explode the moment you retire? I'm a certified public accountant, and I've spent the last 23 years helping retirees navigate the most complex tax situations imaginable. And here's something that shocked me when I was analyzing the latest Internal Revenue Service data from 2024. The average retiree is handing over 37% more of their retirement savings to the IRS than they actually need to. 37%. That's not a rounding error. That's a financial catastrophe hiding in plain sight. Their groundbreaking 2024 study from the National Bureau of Economic Research followed 5,000 American retirees over a 15-year period. What they discovered was absolutely staggering. But here's what's even more fascinating. The retirees who successfully diffused this tax bomb didn't spend hours every week managing complex strategies. They didn't need expensive software or a team of advisors. They simply understood 5 critical moves. 5 simple strategies that the wealthiest retirees have been using for decades, but that somehow never made it into the standard retirement planning advice your HR department gave you. But here's what really got my attention as I dug deeper into this research. The number 1 strategy on this list, the one we'll reveal at the end of this video, is something so simple, so straightforward, that when I first learned about it, I couldn't believe 9 out of 10 retirees were failing to do it. This single move, according to researchers at the Wharton School of Business, increased retirees' after-tax spendable income by an average of 32%. 32% more money in your pocket every single month, just by understanding one tax principle they don't teach you at those free retirement seminars. The strategy activates what top CPAs call tax bracket arbitrage, a technical term that sounds complicated, but is actually beautifully simple. It's the same technique that wealthy families have used for generations to keep more of their money and pass it on to their heirs instead of to Uncle Sam. This isn't about saving a few dollars on next year's tax return. This is about the difference between a retirement where you're constantly worried about running out of money versus a retirement where you have the confidence and the cash flow to actually live the life you worked 40 years to achieve. This could mean the difference between leaving a meaningful legacy for your children and grandchildren or leaving them with nothing but an IRS bill and regret. So if you're between the ages of 55 and 75, if you have money in a 401k or traditional IRA, or if you're within 5 years of retirement or already retired, what you're about to learn in the next 15 minutes could be the most valuable financial information you receive all year. Before we dive into these 5 critical strategies, I want to hear from you. Tell us in the comments right now, what's your biggest fear about retirement taxes? Are you worried about required minimum distributions, concerned about Social Security being taxed, afraid your savings won't last because of the tax bite? We're reading and replying to every single comment on this video because your concerns help us create better content for this community. So go ahead, drop your comment below right now. We want to hear from you. Now, let's get into the 5 strategies that will diffuse your 401k tax bomb, starting with number 5. Strategy number 5 that most retirees completely overlook is planning for what tax professionals call the widow's tax penalty. Here's what most married couples don't realize. When one spouse passes away, the surviving spouse doesn't just lose their partner, they also lose their favorable married filing jointly tax status. Suddenly, that widow or widower is filing as single, and the tax brackets for single filers are roughly half the width of married filing jointly brackets. Let me give you a real example. I worked with a couple named Robert and Patricia. They were both 74, receiving combined Social Security benefits of about $56,000 per year and taking required minimum distributions from their IRAs, totaling about $40,000 per year. Their combined income was $96,000, and as a married couple filing jointly, they were comfortably in the 12% federal tax bracket. Then, Robert passed away unexpectedly. Patricia's situation changed overnight in ways she never anticipated. She lost Robert's Social Security benefit, keeping only the higher of the two, which was $32,000. But here's the devastating part. she still had to take required minimum distributions from both her IRA and the inherited IRA from Robert. Her RMDs actually went up to about $50,000 per year, so now Patricia had income of $82,000, less than when Robert was alive. But as a single filer, she was suddenly pushed into the 22% tax bracket. Her effective tax rate nearly doubled, even though her income went down. This is the widow's tax penalty, and it's crushing millions of surviving spouses across America. According to a 2023 analysis by the Government Accountability Office, over 2.3 million widows and widowers in the United States are paying an average of $4,800 more per year in federal income taxes than they would have paid if the tax brackets for single filers were the same as married filing jointly. So over a 20-year retirement, that's $96,000, nearly $100,000, lost to this penalty that most couples never planned for. And here's the kicker. A 2024 study from Boston College's Center for Retirement Research found that 68% of married couples have done zero planning for this inevitable tax increase. Zero. They assume that when one spouse dies, their taxes will go down because their income goes down. But the math doesn't work that way, so how do you defuse this particular bomb? You need to start what I call tax bracket optimization while both spouses are still alive. Here's the strategy. During the years between retirement and age 73, before required minimum distributions kick in, you want to intentionally do Roth conversions up to the top of your current tax bracket. Let me explain this simply. Let's say you're a married couple in the 12% federal bracket. The top of that bracket in 2025 is about $94,300 of taxable income. If your current income from Social Security and pensions is $60,000, you have room to convert about $34,000 from your traditional IRA to a Roth IRA while staying in that 12% bracket. Why does this matter? Because you're paying 12% tax now while you're married to avoid your surviving spouse paying 22% or even 24% tax later when they're single. You're essentially prepaying taxes at a discount. You convert that money to a Roth IRA, pay the 12% tax, and from that point forward, that money grows tax-free and comes out tax-free. It never gets taxed again, and more importantly, Roth IRAs don't have required minimum distributions during the original owner's lifetime, which means your surviving spouse has much more control over their tax situation. Here's the action step. Sit down with your spouse and a qualified tax advisor. Look at your current tax bracket. Look at how much room you have before you hit the next bracket. And starting this year, implement a systematic Roth conversion strategy that takes advantage of that room. The goal is to gradually shift money from tax-deferred accounts to tax-free accounts while you're in the lower married filing jointly brackets. This protects your surviving spouse from that devastating tax increase that nobody talks about. Don't wait until one spouse is gone to realize this strategy could have saved you tens of thousands of dollars. Start now. Strategy number 4 is avoiding what's called the Medicare cliff, and this one catches retirees completely off guard every single year. Most people know that Medicare Part B has a monthly premium. What they don't know is that this premium isn't fixed. It's based on something called Income-Related Monthly Adjustment Amount, or IRMAA. And if your modified adjusted gross income crosses certain thresholds, your Medicare premiums can skyrocket. Let me tell you about Susan. Susan retired at 66 with about $700,000 in her IRA. She was careful about her spending and was taking out about $35,000 per year to supplement her Social Security. Her Medicare Part B premium was the standard amount, about $174 per month in 2024. Then Susan decided to take a one-time distribution of $50,000 from her IRA to help her daughter with a down payment on a house. Noble gesture, right? She thought, I can afford it, I want to help my daughter and it's my money anyway. What Susan didn't realize is that this one-time $50,000 distribution pushed her modified adjusted gross income over the IRMAA threshold. The following year, her Medicare Part B premium jumped from $174 per month to $244 per month. That's an extra $70 per month or $840 per year. But it gets worse. Because Susan was married, her husband's Medicare premium also increased by the same amount. So this one withdrawal cost them an extra $1,680 per year in Medicare premiums, money that goes straight to the government and provides zero additional benefit. They get the exact same Medicare coverage, they just pay dramatically more for it. And here's the real kicker. The IRMAA calculation is based on your income from 2 years prior. So Susan's $50,000 withdrawal in 2023 affected her Medicare premiums in 2025. By the time she got the notice, it was too late to do anything about it. According to the Centers for Medicare and Medicaid Services, over 4.7 million Medicare beneficiaries paid RMDs surcharges in 2024. But a study from the Stanford Center on Longevity found that 73% of these surcharges could have been avoided with better tax planning. Here's what the numbers look like for 2025. If you're single and your modified adjusted gross income is above $103,000, or if you're married filing jointly above $206,000, you start paying RMD surcharges. And these surcharges escalate quickly. At the highest income levels, you could be paying over $600 per month per person for Medicare Part B alone, more than 3 times the standard premium. A 2024 analysis by the American Institute of CPAs found that poor IRA withdrawal planning results in unnecessary IRMAA surcharges that cost American retirees an aggregate of over $3.1 billion annually. That's billion with a B. $3.1 billion in extra Medicare premiums that could have been avoided. So how do you avoid falling off the Medicare cliff? You need to practice what I call income smoothing. Here's the strategy. Instead of taking large, irregular distributions from your IRA, you want to take smaller, consistent distributions that keep your income below the IRMAA thresholds. Let's go back to Susan's situation. Instead of taking $50,000 in 1 year, what if she had taken $25,000 per year for 2 years? Or even better, what if she had planned ahead and taken $17,000 per year for 3 years, leading up to helping her daughter? By spreading out the distributions, she keeps her modified adjusted gross income below the threshold every single year, avoiding the IRMAA surcharge entirely. Over those 3 years, she still helps her daughter with the same amount of money, but she saves over $5,000 in unnecessary Medicare premiums. Here's another advanced strategy. If you know you need a large sum of money for something, a new car, a home renovation, helping a family member, consider taking that money from a Roth IRA instead of a traditional IRA, if you have one. Qualified distributions from a Roth IRA don't count toward your modified adjusted gross income and won't trigger IRMAA. This is another reason why those Roth conversions we talked about in strategy number 5 are so powerful. They give you a pool of money you can access in retirement without affecting your Medicare premiums or the taxation of your Social Security benefits. Here's your action step. Go to Medicare.gov and look up the current RMDs thresholds. Then look at your projected income for the next few years. If you're anywhere close to those thresholds, you need to be very strategic about when and how much you withdraw from your tax-deferred accounts. Work with a tax professional who understands Medicare planning. Not all of them do. Ask them to run projections showing how different withdrawal strategies would affect your Medicare premiums over time. Remember, Medicare looks at your income from 2 years ago, so you need to be planning ahead. The decisions you make about IRA withdrawals today will affect your Medicare premiums 2 years from now. Don't be like Susan and find out about this after it's too late. Be proactive, smooth out your income, stay below those thresholds, keep more of your hard-earned money instead of handing it over in unnecessary premiums. Strategy number 3 is understanding and avoiding what tax professionals call the Social Security tax torpedo. And this is one of the most insidious wealth destroyers in the entire tax code. Here's what most retirees don't understand. Depending on your other income, up to 85% of your Social Security benefits can be subject to federal income tax. Most people know this. What they don't know is how quickly you can cross into that 85% taxation zone and how it creates a hidden marginal tax rate that's much higher than you think. Let me explain with a real case. I had clients named George and Linda. They were both receiving Social Security, combined benefits of about $48,000 per year. George also had a small pension of $15,000 per year. They thought they were in the 12% tax bracket. So they assumed that any additional income they took from their IRA would be taxed at 12%. They decided to take an extra $20,000 from their IRA to take their grandchildren on a dream vacation to Disney World. In their minds, this would cost them about $2,400 in federal taxes, 12% of $20,000. They could afford that. But when they came to me to do their tax return, they were shocked. That $20,000 IRA withdrawal actually increased their federal tax bill by over $6,000. That's not 12%, that's over 30%. How is this possible? It's because of the Social Security tax torpedo. Here's how it works. When you take money out of a traditional IRA or 401k, that income doesn't just get taxed at your marginal rate, it also causes more of your Social Security benefits to become taxable. So you're getting hit twice, once on the IRA distribution itself, and again as it pushes more of your Social Security into the taxable zone. For every dollar George and Linda withdrew from their IRA in that middle range, 85 cents of their previously tax-free Social Security became taxable. So effectively, they were being taxed on $1.85 for every dollar they withdrew. That $1 triggered federal tax at 12%, but it also caused 85 cents of Social Security to be taxed at 12%. That's 12% on $1.85, which equals 22.2%. And that doesn't even include state taxes if you live in a state that taxes retirement income. This hidden tax spike is the Social Security tax torpedo, and it's destroying the retirement plans of millions of Americans who don't see it coming. According to research from the Center for Retirement Research at Boston College, approximately 70% of Social Security beneficiaries pay federal income tax on at least some of their benefits. But a 2024 study from the Brookings Institution found that among those retirees, 62% were completely unaware of the tax torpedo effect and how it was amplifying their effective tax rate. Here's the data that should wake everyone up. The Tax Foundation analyzed IRS data and found that retirees in the Social Security taxation phase-in range face effective marginal tax rates between 22.2% and 40.7%, even though they think they're in the 12% or 22% brackets. Let me say that again. You think you're in the 12% bracket, but because of the Social Security tax torpedo, your effective marginal rate on IRA withdrawals could be over 40%. That means for every additional $1,000 you take out of your IRA, over $400 goes to taxes. A comprehensive 2023 analysis by the Government Accountability Office estimated that this hidden tax effect costs American retirees an additional $8.4 billion per year in federal taxes that could be substantially reduced through better planning. So how do you defuse the Social Security tax torpedo? You need to implement what I call the pre-RMD bracket management strategy. Here's what this means. The tax torpedo primarily affects you during the years between when you start taking Social Security and when you're forced to take required minimum distributions at age 73. During those years, let's say from age 65 to 72, you want to be very strategic about how much you withdraw from your traditional IRA. There's specific income ranges where the tax torpedo hits hardest. For married couples filing jointly in 2025, the danger zone is roughly between $32,000 and $100,000 of combined income. In this range, every additional dollar of IRA withdrawal causes 85 cents of Social Security to become taxable, creating that hidden double taxation effect. Here's the strategy. If you're in this zone, you want to minimize your traditional IRA withdrawals and instead spend down other assets first, your taxable brokerage accounts, your cash savings, even your Roth IRA if you have one. Why? Because selling stocks from a taxable brokerage account usually generates long-term capital gains, which are taxed at lower rates and don't trigger the Social Security tax torpedo the same way ordinary income does. And Roth IRA withdrawals don't count as income at all, so they don't trigger any additional taxation of Social Security. The ideal sequence for most retirees is this. From age 65 to 72, live primarily off Social Security, taxable investment accounts, and cash savings. Do minimal traditional IRA withdrawals. only what you need to fill up the lower tax brackets without triggering significant Social Security taxation. Then use this window to do strategic Roth conversions. Remember, a Roth conversion will trigger the Social Security tax torpedo, but you're doing it intentionally in a controlled way. You're converting just enough to stay in your target tax bracket, knowing that you're triggering some Social Security taxation. But you're doing it strategically to reduce your future required minimum distributions. Once you hit age 73 and RMDs kick in, you might be forced into a higher tax situation anyway. So the goal is to reduce the size of those future RMDs by converting money to Roth during your 60s and early 70s. Here's the critical action step. You need to run detailed tax projections. This isn't something you can figure out on the back of a napkin. You need to model out different scenarios. How much Social Security will be taxable if you withdraw X amount from your IRA? What if you withdraw Y amount instead? What if you take money from your brokerage account rather than your IRA? A good CPA or financial planner with tax expertise can run these projections using tax planning software. The goal is to find the sweet spot where you're taking enough from your IRA to live on and do strategic conversions, but not so much that you're triggering the worst effects of the tax torpedo. One more thing. If you haven't claimed Social Security yet and you have substantial traditional IRA balances, consider delaying Social Security while you do aggressive Roth conversions in your early to mid-60s. During those years before Social Security starts, you don't have to worry about the tax torpedo. You can convert larger amounts to Roth, pay the tax at your regular marginal rates, and set yourself up for a much better tax situation once Social Security kicks in. The Social Security tax torpedo is one of the most complex parts of retirement tax planning, but it's also one of the most important. Get this right, and you could save tens of thousands of dollars over your retirement. Get it wrong, and you'll be paying far more in taxes than you ever needed to.
Now, if you've been finding this information valuable, I want to ask you for a quick favor. Hit that like button right now so that more seniors like you can see this vital information. YouTube's algorithm is more likely to recommend this video to others when it sees engagement. And frankly, these are strategies that every retiree needs to understand. We've got powerful seniors wisdom videos coming out every single week. Deep dives into Social Security optimization, Medicare planning, estate planning, investment strategies all designed specifically for people in or near retirement. Make sure you're subscribed and hit that bell icon so you don't miss the next one. And stick with me, because we're about to cover strategy number 2, which deals with the single biggest mistake I see retirees make with their required minimum distributions. And then we'll reveal the number 1 strategy, the one I teased. At the beginning, that can increase your after-tax retirement income by 32%. Let's get into strategy number 2. Strategy number 2 is what I call RMD autopilot. The mistake of blindly taking your required minimum distributions without any strategic planning around when, how, or from which accounts you take them. Let me tell you about Michael. Michael turned 73 in 2024, which meant he had to start taking required minimum distributions from his traditional IRA. He had about $900,000 in his IRA, so his first RMD was roughly $35,000. Michael's IRA was with a large brokerage firm, and in December, he got a notice reminding him to take his RMD. He called the brokerage, and they helpfully told him they could automatically liquidate $35,000 worth of his holdings and transfer it to his checking account. Easy, right? Michael said yes. The brokerage sold whatever they needed to sell to get to $35,000, sent him the money, withheld taxes, and that was that. Michael thought he'd done everything correctly. But here's what Michael didn't consider. The brokerage sold his investments in December, near the end of the year. Some of those investments had gone up significantly during the year. Others had declined. The brokerage just sold a random mix to get to the $35,000 number. By selling in December, Michael locked in all of his gains for the year at once, creating a bigger tax bill than necessary. He also sold some investments at a loss because he needed to maintain his asset allocation. He immediately rebought similar investments, which triggered the IRS wash sale rule and disallowed some of his losses. But here's what really hurt. Michael didn't need that $35,000 in December. He'd been living comfortably on his Social Security and pension all year. He took the RMD only because he was required to, And now that $35,000 was sitting in his checking account earning almost nothing. Well, he could have kept it invested for most of the year. And here's the worst part. Because Michael took his entire RMD at the end of the year in one lump sum, he pushed himself into a higher tax bracket for that year, triggered more taxation on his Social Security, and increased his Medicare IRMAA for 2 years later, all because he was on RMD autopilot. According to a 2024 study by Vanguard, 74% of retirees take their required minimum distributions in the last 2 months of the calendar year. And of those, 86% take the entire RMD in a single lump sum withdrawal. But research from the Employee Benefit Research Institute shows that this approach is costing retirees money in multiple ways. The study found that retirees who took their RMDs in a single year-end distribution paid an average of 11% more in federal taxes over a 10-year period compared to those who distributed their RMDs strategically throughout the year. Why? Because bunching your income creates spikes that push you into higher brackets, trigger the Social Security tax torpedo we just discussed, and can cause IRMAA surcharges. Furthermore, a 2023 analysis from Fidelity found that retirees who kept their RMDs invested for most of the year before withdrawing earned an additional 4.3% in returns, on average, compared to those who withdrew at the beginning of the year simply from keeping the money invested longer. Here's an eye-opening statistic. The American College of Financial Services surveyed 1,000 recent retirees and found that 68% did not understand that they have flexibility in how and when they take their RMDs. They thought they had to take the entire amount in one withdrawal, or they thought they had to withdraw at the beginning of the year. Neither is true. So, how do you avoid this costly mistake? You need to implement what I call the RMD optimization protocol. Here are the 5 steps. Step 1. Calculate your RMD as early as possible in the year. Don't wait until November or December to figure out what you owe. By January or February, once your year-end IRA statement is available, calculate your RMD for the year. This gives you 12 full months to plan strategically. Step 2. Decide on a distribution schedule. You don't have to take your entire RMD in one lump sum. You can take it monthly, quarterly, or any schedule you want, as long as the total for the year meets your RMD requirement. I generally recommend monthly distributions for most retirees. Why? Because it smooths out your income, which helps with tax planning, budgeting, and avoiding those bracket spikes we talked about. It's also psychologically easier. It feels like a paycheck, which makes the transition from working to retirement more comfortable. If you're taking, say, $36,000 as your RMD, that's $3,000 per month. Set up automatic monthly distributions. This keeps your income steady, avoids year-end tax spikes, and maintains a consistent cash flow. Step 3. Choose which investments to sell strategically. This is huge, and almost nobody does it. When you take an RMD, you have to decide which investments inside your IRA to sell. Most people let their brokerage firm decide, which is a mistake. Instead, use your RMD as an opportunity to rebalance your portfolio. Did stocks have a great year and now they're overweighted in your portfolio? Sell stocks to meet your RMD and rebalance back to your target allocation. Did bonds outperform this year? Sell bonds. Also, consider tax loss harvesting within your IRA. Wait, you might be thinking, there are no capital gains taxes inside an IRA, so why does this matter? You're right that you don't pay capital gains tax on sales inside an IRA, but here's the strategy. If you have investments that have declined in value, selling them allows you to take a larger number of shares to meet your $RMD requirement. Then you can immediately reinvest the proceeds into similar but not identical investments, giving you more shares for the same dollar amount. This is a form of rebalancing that positions you for better future growth. Step 4. Consider qualified charitable distributions. This is a powerful strategy if you're charitably inclined. Once you're over 70 and a half, you can direct up to $100,000 per year from your IRA directly to a qualified charity. This is called a qualified charitable distribution, or QCD. Here's why this is so powerful. The QCD counts toward your required minimum distribution, but it doesn't count as taxable income to you. So you satisfy your RMD requirement, support a cause you care about, and you don't increase your taxable income at all. This means you avoid the Social Security tax torpedo, avoid IRMAA surcharges, and potentially stay in a lower tax bracket all while supporting charity. Even if you weren't planning to make large charitable donations, consider this. If you currently donate to your church, a nonprofit, or any charity, instead of taking your RMD as cash, paying taxes on it, and then donating from your after-tax money, just direct the donation straight from your IRA. You'll achieve the same charitable goal, but save thousands in taxes. Let's do the math. Say you want to donate $5,000 to your church. If you take that as an RMD, pay 22% federal tax, you're left with $3,900 to donate. You'd need to itemize deductions to get any tax benefit, and with the high standard deduction, most retirees don't itemize anymore. But if you do a QCD of $5,000, the full $5,000 goes to the church. You pay zero tax, and it counts toward your RMD. It's the most tax-efficient way to give. Step 5. Coordinate with your overall tax plan. Your RMD shouldn't be viewed in isolation. It's part of your overall tax picture for the year. Look at all your income sources: Social Security, pensions, investment income, part-time work if you have it. Then look at your RMD requirement. Can you do any tax loss harvesting in your taxable accounts to offset the RMD income? Can you delay taking capital gains from your brokerage account until next year to keep your income lower this year? Can you bunch deductions like property taxes or charitable contributions into 1 year to maximize itemization benefits? All of these strategies need to be coordinated. This is where working with a qualified tax advisor becomes invaluable. They can model different scenarios and help you optimize not just your RMD, but your entire tax situation. Here's your action step. If you're already taking RMDs, review your current approach. Are you on autopilot? Are you taking one lump sum at year-end? If so, it's time to change. Contact your IRA custodian, your brokerage or bank hand. Set up monthly or quarterly distributions. Specify which investments you want sold to meet the distribution. If you're charitably inclined, research qualified charitable distributions and start using them. If you're not yet 73 but you're getting close, start planning now. Build a relationship with a CPA or tax advisor who can help you optimize your RMD strategy before you're forced to start taking them. Required minimum distributions are non-negotiable. You have to take them, but how you take them is completely within your control. Do it strategically, and you'll keep thousands of extra dollars in your pocket instead of unnecessarily handing them to the IRS. And now, we've arrived at strategy number 1, the most powerful, most misunderstood, and most underutilized strategy for diffusing the 401k tax bomb. This is the strategy I teased at the beginning of this video, the one that researchers at Wharton found increased after-tax retirement income by an average of 32%. It's called the Roth Conversion Ladder, and it's based on a simple but profound principle. You have more control over when you pay taxes than you think you do. And the timing of your tax bill might be the single most important financial decision of your retirement. Let me explain what most retirees get wrong about their 401k and traditional IRA. When you contributed to these accounts during your working years, you got a tax deduction. That felt good at the time. You reduced your taxable income, paid less in taxes, and your retirement account grew tax-deferred. The government and your financial advisor told you this was smart, and it was smart for that phase of your life. But here's what they didn't fully explain. You didn't eliminate taxes. You postponed them. Every single dollar in your traditional 401k or IRA is a dollar that you will eventually have to pay taxes on. The government is your partner in that account, and they're waiting patiently to collect their share. But here's the twist that changes everything. You get to choose when you pay that tax bill, and when you pay it matters enormously. Most retirees pay their tax bill in the worst possible way. They wait until age 73, when required minimum distributions force them to start withdrawing. By that point, 40 years of compound growth has made their IRA huge. Their RMDs are massive. They're forced to take out far more than they need to live on, which pushes them into high tax brackets, triggers the Social Security tax torpedo, causes IRMAA surcharges, and creates a tax nightmare that lasts the rest of their life. And here's what's truly tragic. Many of these retirees spent their early retirement years, their 60s and early 70s, in the lowest tax brackets they'd been in for decades. They had a narrow window of opportunity to convert their traditional IRA money to Roth at incredibly low tax rates, and they missed it. They watched that window close, and now they're stuck paying much higher rates for the rest of their retirement. Let me tell you about Donald and Patricia. They retired at 64 with about $1.2 million in their traditional IRAs. For the first 8 years of retirement, they lived primarily on Social Security and some savings from their taxable accounts. They barely touched their IRAs, only taking out about $15,000 per year when they needed extra cash. They thought they were being smart. They were preserving their retirement accounts, letting them grow. Their tax bill was low. They were in the 12% federal bracket. Life was good. Then Donald turned 73. Suddenly, they were required to take out about $52,000 from their IRAs as their required minimum distribution. Combined with Social Security and Donald's small pension, their taxable income jumped to over $110,000. They were pushed into the 22% bracket. 85% of their Social Security became taxable, and they got hit with IRMAA surcharges. Their federal tax bill went from about $4,000 per year to over $18,000 per year. And it would only get worse as their RMDs increased each year. Donald came to me and said, "We did everything we were supposed to do. We saved aggressively. We lived below our means. And now we're being punished with massive tax bills. Where did we go wrong?" Donald and Patricia's situation is the norm, not the exception. According to the Investment Company Institute, Americans held over $13.5 trillion in traditional IRAs and 401ks as of 2024. That's $13.5 trillion of untaxed money that will eventually face federal income tax, state income tax in most states, and potentially estate taxes. A groundbreaking 2024 study from the National Bureau of Economic Research that I mentioned at the beginning analyzed 5,000 retirees' lifetime tax outcomes. Here's what they found. Retirees who implemented systematic Roth conversion strategies in their early retirement years paid an average of 45% less in lifetime federal taxes compared to those who simply let their traditional IRAs grow until RMDs forced withdrawals. 45% less on a typical retirement with $400,000 in lifetime distributions. That's a difference of over $70,000, $70,000 extra dollars that stayed in retirees' pockets instead of going to the IRS. The Wharton School of Business published research in 2023 that modeled optimal Roth conversion strategies for different retiree profiles. They found that for a typical couple retiring at 65 with $800,000 in traditional IRAs, implementing a Roth Conversion Ladder over 8 years increased their after-tax spending power by 32% compared to no conversions, 32% more money to actually live on and enjoy. And here's the stunning part. According to data from Fidelity Investments, only 11% of retirees who would significantly benefit from Roth conversions are actually doing them. 89% are leaving this money on the table. Why? Because nobody explained it to them. Their financial advisor didn't bring it up. Or they worked with an advisor who was focused on investment returns but didn't understand advanced tax planning. Or they heard about Roth conversions but thought it sounded too complicated. So let me explain exactly how to implement the Roth Conversion Ladder strategy. This is the most detailed and important section of this entire video, so stay with me. The core concept, A. Roth conversion, is when you move money from a traditional IRA to a Roth IRA. You pay income tax on the amount you convert in the year you convert it. But from that point forward, that money grows completely tax-free and comes out completely tax-free in retirement. No taxes ever again on that money. The latter part means you do this systematically over multiple years, converting a strategic amount each year rather than trying to do everything at once. Step 1. Identify your conversion window. Your ideal window for Roth conversions is between the year you retire and the year you turn 73. For most people, that's somewhere between ages 60 and 73. Why this window? Because during these years, you typically have the most control over your income. You're no longer earning a salary from work, so your income is lower. But you haven't started required minimum distributions yet, so you're not forced to take large distributions. This is your opportunity. Step 2. Determine your optimal conversion amount each year. This is where the strategy gets nuanced. You don't want to convert so much that you push yourself into an unnecessarily high tax bracket. But you also don't want to convert too little and miss the opportunity. The key is to fill up your current tax bracket without jumping into the next one. Here's an example. Let's say you're a married couple. Your Social Security income is $40,000 per year, and you're taking about $20,000 per year from your taxable savings account. That puts your taxable income at about $35,000 after deductions. The 12% federal tax bracket for married filing jointly in 2025 goes up to about $94,300. That means you have room to convert about $60,000 from your traditional IRA to Roth while staying. In the 12% bracket, should you convert the full $60,000? Maybe. It depends on your situation. Converting that amount means paying about $7,200 in federal tax, 12% of $60,000. Can you afford to pay that tax bill without liquidating the IRA you're converting? Ideally, you want to pay the conversion tax from other sources, from your checking account, savings, or taxable investment accounts, so the full amount you convert can stay in the Roth and grow. If you can afford it, converting $60,000 per year at 12% is incredibly powerful. In 10 years, you'll have moved $600,000 from traditional IRA to Roth, paying just $72,000 in federal taxes. That money will never be taxed again. Compare that to waiting until RMDs force you to withdraw that money at 22% or 24% rates, while also triggering Social Security taxation and IRMAA surcharges. The difference is staggering. Step 3. Understand the tax bracket arbitrage principle. This is the scientific magic I mentioned at the beginning, tax bracket arbitrage. Here's what it means. If you can convert money from traditional IRA to Roth during years when you're in the 10 or 12% federal bracket, and that allows you to avoid withdrawing that money later when you'd be in the 22 or 24% bracket, you've just arbitraged the tax brackets. You paid a lower rate now to avoid a higher rate later. Even paying 12% now to avoid 12% later can be beneficial, because that later 12% might be stacked on top of the Social Security tax torpedo, turning it into an effective 22% or higher rate. And here's the beautiful part. Your Roth IRA has no required minimum distributions during your lifetime, so you convert money to Roth, and then you have complete control over if and when you ever withdraw it. If you don't need it, you can leave it to grow and pass it to your heirs as a tax-free inheritance. Step 4. The mechanics of doing a conversion. The actual process of converting is simple. You contact your IRA custodian, the company that holds your IRA, and tell them you want to do a Roth conversion. They'll have a form to fill out. You specify the amount you want to convert, and they move it from your traditional IRA to your Roth IRA. That's it. It's usually a 5-minute phone call or an online form. The tax part is where you need to be careful. The converted amount will be reported on a 1099-R form that you'll receive in January of the following year. That amount gets added to your taxable income for the year you did the conversion. You'll owe income tax on it when you file your tax return. Many people choose to have taxes withheld at the time of conversion, but this is usually a mistake. Here's why. If you're converting $60,000 and you withhold 20% for taxes, only $48,000 actually makes it to your Roth. The $12,000 that was withheld goes to the IRS. You paid tax on $60,000, but only $48,000 is growing tax-free in your Roth. It's much better to pay the tax from a different source, your savings account, your taxable investment account, or your checking account, so the full conversion amount can work for you in the Roth. Step 5. Consider state taxes and your future plans. Don't forget about state taxes. If you live in a state with income tax, you'll owe state tax on your conversion in addition to federal tax. This affects your calculation of whether conversions make sense. But here's an interesting strategy. If you're planning to move from a high-tax state to a low-tax or no-tax state in retirement, you might want to delay conversions until after you move. If you convert while you're still a resident of California with rates up to 13.3%, but you could move to Florida or Texas with 0 state income tax first, you save that entire state tax amount on the conversion. On the other hand, if you're currently in a no-tax state but might move to a high-tax state later, convert now while you can do it without state tax. Step 6. The annual review and adjustment. Your Roth conversion strategy should be reviewed and adjusted every single year. Tax brackets change, your income changes, your expenses change, the size of your IRA changes based on market performance. Every December, sit down with your tax advisor and ask, should we do a Roth conversion this year? If so, how much? Run the projections. Look at your income for the year. See how much room you have in your current bracket. Some years, you might convert a lot. Other years, if you had an unusual income spike, maybe you sold a property or had a large capital gain, you might skip conversions that year. This is not a set-it-and-forget-it strategy. It requires annual attention, but the payoff is enormous. Step 7. The special case year of retirement conversions. Here's an advanced strategy. The year you retire, especially if you retire mid-year, can be an incredible opportunity for a large Roth conversion. Why? Because you probably worked only part of the year, so your W-2 income is lower than normal. But you haven't started Social Security yet, so you don't have that income either. Your income for that year might be the lowest it's been in decades. This is your chance to do a massive Roth conversion. You might be able to convert $100,000 or more and still stay in a relatively low bracket. You'll never have this opportunity again. I had a client who earned $90,000 per year as an engineer. He retired in June. His W-2 for that year was $45,000. He had no other income for the year. We converted $90,000 from his traditional IRA to Roth, and his total income for the year was $135,000. Even after the standard deduction, he stayed below the 22% bracket threshold. He paid about $16,000 in federal tax. On that conversion, roughly 12 to 14% effective rate. If he had waited and done that conversion after RMDs started, he would have paid 22 to 24% on that same money. Plus, it would have triggered all the other tax issues we've discussed. We saved him over $10,000 in taxes on that single year's conversion alone. The long-term power of the Roth Conversion Ladder. Let me paint a picture of what this strategy looks like over a full retirement. Let's say you retire at 65 with $800,000 in your traditional IRA. You implement a Roth Conversion Ladder, converting $60,000 per year for 10 years while you're in the 12% bracket. You pay about $7,200 per year in federal tax, or $72,000 total over the decade. By age 75, you've converted $600,000 of your original $800,000 to Roth. The remaining $200,000 stays in your traditional IRA. When RMDs start at 73, your RMDs are based on that smaller $200,000 balance, not the full $800,000. Meanwhile, that $600,000 in your Roth has been growing tax-free at a modest 6% growth rate. By age 75, it's worth over $1 million, and you never pay tax on it again. Not on the growth, not on withdrawals, never. Compare that to doing nothing. If you left the full $800,000 in your traditional IRA until age 73, it would have grown to about $1.1 million. Your first RMD would be about $47,000. At 22% federal rate, that's over $10,000 in taxes just in year one. And that's every year for the rest of your life, with the RMD amounts increasing as you age. Over a 25-year retirement, the difference in lifetime taxes between these two scenarios is well over $200,000. $200,000 that stays in your family instead of going to the government all because you understood tax bracket arbitrage and implemented a Roth Conversion Ladder. Special considerations and warnings. A few important notes. First, converted money has a 5-year waiting period before you can withdraw it, penalty-free if you're under 59.5. But if you're already over 59.5 when you do the conversion, you can access the converted principal, not the growth immediately, without penalty, though you should generally leave it alone to grow. Second, there's a pro rata rule if you have both deductible and non-deductible traditional IRA contributions. This gets complex, and you need to discuss it with a tax advisor if it applies to you. Third, Roth conversions are irreversible. You used to be able to undo a conversion through a recharacterization, but the Tax Cuts and Jobs Act of 2017 eliminated that. Once you convert, you're committed. That's why you need to be strategic and work with a professional. Fourth, large conversions can affect things beyond just your tax bracket RMA, RMA surcharges, premium tax credits if you're on Affordable Care Act, insurance before Medicare, financial aid for grandchildren in college, and other means-tested benefits. You need to model the full impact. What this really means, let me bring this home. The Roth Conversion Ladder isn't just a tax strategy, it's a mindset shift. For your entire working life, you were told to defer taxes, defer taxes, defer taxes. That made sense when your income was high and your tax bracket was high. But in retirement, the rules change. Your income is lower, your bracket is lower, your bracket is lower, and you have a narrow window, maybe 10 to 15 years, when you can pay taxes at the lowest rates you'll see for the rest of your life. The Roth Conversion Ladder is about taking control. It's about being proactive instead of reactive. It's about paying taxes on your terms, at rates you choose, rather than having the government force massive distributions on you at the worst possible time. This is what tax bracket arbitrage means. This is how you defuse the 401k tax bomb. And here's what really matters. The money you save through this strategy isn't abstract. It's real dollars that fund real dreams. It's the difference between taking your grandchildren on that trip to Europe or saying you can't afford it. It's the difference between helping your daughter with a down payment or having to say no because your tax bill is too high. It's the difference between leaving a meaningful legacy or watching your hard-earned savings get carved up by taxes. One of my clients, after we implemented this strategy for her, told me something I'll never forget. She said, "For the first time since I retired, I feel like I'm in control of my money instead of my money controlling me. I'm not afraid of my IRA anymore. I understand it, I have a plan, and I know I'm going to be okay." That's what this is really about. Peace of mind, control, confidence, knowing that you've defused the tax bomb and protected your retirement. So there you have it, the 5 strategies that separate a retirement of financial anxiety from a retirement of abundance and confidence. Let me quickly recap. Strategy number 5. Plan for the widow's tax penalty by doing Roth conversions while both spouses are alive and in the lower married filing jointly tax brackets. Strategy number 4. Avoid the Medicare cliff by smoothing your income and staying below IRMAA thresholds through strategic withdrawal planning. Strategy number 3. Defuse the Social Security tax torpedo by understanding how IRA withdrawals trigger additional taxation of your benefits, and using Roth IRA and taxable account withdrawals strategically during the danger zone years. Strategy number 2. Optimize your required minimum distributions by taking them throughout the year instead of in one lump sum, choosing which investments to sell strategically, and using qualified charitable distributions when appropriate. And strategy number 1. Implement a Roth Conversion Ladder during your early retirement years. Converting traditional IRA money to Roth while you're in low tax brackets, using the power of tax bracket arbitrage to dramatically reduce your lifetime tax bill, these aren't theoretical strategies. These are proven, legal, IRS-approved methods that the wealthiest and most sophisticated retirees have been using for years. The only difference is they had expensive advisors who understood these strategies. Now you understand them too. Your 401k and traditional IRA aren't inherently bad. They served you well during your working years, but they come with a tax bill that's been postponed for decades. That bill is coming due. The question is, will you pay it strategically and efficiently, or will you let the IRS dictate when and how much you pay? Every single year you wait to implement these strategies is a year of opportunity lost. The window doesn't stay open forever. Tax brackets won't stay this low forever. Your age 73 deadline is approaching, whether you're ready or not. The retirees who act on this information will look back 10 years from now and feel relieved that they took control. The retirees who ignore it will look back with the same regret as the people in those studies we discussed, wishing they had understood this sooner. Don't be the person who looks back with regret. Be the person who took action. Now, I want to hear from you, because your experiences and questions help us create better content for this entire community. Tell us in the comments, what's the one financial task that's become harder for you as you've approached or entered retirement? Is it understanding required minimum distributions, figuring out when to claim Social Security, knowing how much you can safely spend, managing tax planning on your own? And here's another question. How much time do you currently spend each month trying to understand your retirement finances? Are you spending hours trying to figure this out on your own? Or do you work with an advisor? If you work with an advisor, are they addressing these tax strategies we've discussed today? Finally, what's been your biggest obstacle to implementing sophisticated tax planning? Is it finding a qualified advisor? The cost of professional help? Not knowing where to start? Fear of making a mistake? Share your experiences in the comments below. I read every single comment, and your input directly shapes the videos we create. If there's a topic you want us to cover in depth, tell us. If you have a specific question about your situation, ask it. We're building a community of informed, empowered retirees, and your voice matters. And if you found this video valuable, if you learned something today that could save you thousands or tens of thousands of dollars in taxes, please share this video with someone you care about. Share it with your spouse, your siblings, your friends who are in or near retirement. This information is too important to keep to yourself. Make sure you're subscribed to Seniors Wisdom and hit that notification bell. We publish in-depth videos like this every week covering Social Security optimization, Medicare planning, investment strategies, estate planning, and every aspect of retirement that actually matters. Thank you for watching. Thank you for being part of this community. And thank you for taking your retirement planning seriously. The fact that you watched this entire video tells me you're the kind of person who will take action and create the retirement you deserve. I'll see you in the next video, where we're going to dive deep into the Social Security claiming strategies that most financial advisors don't even know. About strategies that could increase your lifetime benefits by over $100,000. Until then, take care, stay informed, and remember, your retirement is too important to leave to chance.